1. UK jobless rate hits 4-year high, what it means for interest rates. 2. Bank of England's dilemma, weakening UK job market amid persistent inflation. 1. UK jobless rate hits 4-year high, what it means for interest rates. Unemployment has skyrocketed to its highest point in 4 years, and counterintuitively, this could be the catalyst for much-needed economic relief. But here's where it gets controversial. While rising joblessness typically signals trouble, this downturn actually strengthens the argument for imminent interest rate cuts by the Bank of England. Let's unpack this economic paradox. Fresh data from the Office for National Statistics reveals the UK's unemployment rate jumped unexpectedly to 4.7% during the 3 months ending in May, climbing from 4.6%. This marks the highest level seen since 2020 and defies economist predictions that the rate would stabilize after last month's minor 0.1 percentage point increase. These ONS figures, which carry caveats about unreliable participation rates, simultaneously show wage growth is cooling. Average weekly earnings rose by 5%, a noticeable dip from the 5.2% increase recorded the previous month. ONS Economic Statistics Director Liz McEwen contextualized the findings. Our labor market shows continued weakening, with declining payroll numbers. However, updated tax records suggest recent drops aren't as severe as we first believed. While pay growth has slowed in both nominal and real terms, it remains historically robust. Adding to the complexity, job vacancies have now declined steadily for 3 consecutive years, painting a picture of sustained employer caution. This jobs report arrives just 1 day after inflation unexpectedly surged to 3.6%, creating conflicting signals for Bank of England policymakers. Here's the critical twist most observers miss. Despite this inflationary pressure, economists widely anticipate a 0.25% interest rate reduction in early August, bringing rates down to 4%. Why would the bank cut rates when inflation is rising? Officials appear focused on the worsening employment landscape and easing wage pressures, factors Bank Governor Andrew Bailey recently emphasized in a Times interview as increasingly pivotal for 2025 economic stability. But this is where controversy erupts. Weakening pay growth remains essential for lowering borrowing costs. Why? Because since August 2023, UK inflation has proven stubborn, partly due to wages rising faster than prices, a vicious cycle where pay hikes fuel continued price increases. Compounding this, the UK economy has shrunk for 2 consecutive months, creating a stagflation nightmare, stagnant growth paired with inflation stubbornly above the bank's 2% target. New Chancellor Rachel Reeves faces mounting pressure amid these conflicting economic signals. Controversially, industry groups blame her April tax policies for worsening inflation, specifically claiming grocery price surges stem partly from businesses passing on new employment taxes and minimum wage increases. Simultaneously, these budgetary measures have clearly suppressed hiring since spring. Retail giant Frasers Group, owner of Sports Direct, explicitly attributed £50 million in new costs to these policies, revealing they're turning to AI-driven efficiencies to offset the financial hit. The lone silver lining for Reeves? An August rate cut appears increasingly likely, which would reduce government debt servicing costs, crucial when her fiscal options are constrained by U-turns on winter fuel payments and welfare reforms. This leaves a looming autumn budget dilemma: cover shortfalls through tax increases or spending cuts. KPMG UK chief economist Yael Selfin summarizes, with hiring slowing and pay pressures easing, the bank will likely cut rates next month. April's tax changes caused a sharp hiring pullback, and with domestic activity sluggish, the Monetary Policy Committee will probably loosen policy to prevent greater labor market damage. Now we turn to you. With inflation rising but unemployment worsening, should the Bank of England prioritize fighting inflation or preventing job losses? Do government policies genuinely worsen inflation, as industry claims? Share your perspective below. This debate hits at the core of our economic future. 2. Bank of England's dilemma: weakening UK job market amid persistent inflation. Imagine a scenario where the UK's job market is weakening, and inflation is stubbornly high. This is the predicament facing the Bank of England, as the country's employment landscape becomes increasingly uncertain. The latest consumer price data reveals a 3.6% year-on-year increase, up from 3.4% in May. This acceleration is a far cry from the relief that Chancellor Rachel Reeves was hoping for. But here's where it gets complicated. The UK's inflation woes are not unique. Across the globe, central banks are grappling with the consequences of sticky inflation. Take Russia, for instance, where President Putin has explicitly warned his officials against allowing a recession to take hold. During the St. Petersburg International Economic Forum, Putin emphasized that a recession is not to be allowed under any circumstances. This stance highlights the delicate balance between economic growth and inflation control. And this is the part most people miss. The European Central Bank, ECB, is also playing a crucial role in shaping the global economic landscape. ECB President Christine Lagarde recently urged China to reassess its economic policies, emphasizing the need for both China and the US to share the burden of closing the massive trade gap threatening the global economy. This call to action underscores the interconnectedness of the world's economies and the need for cooperation to address pressing issues. But what does this mean for the UK? As the job market weakens, the Bank of England faces a daunting task, navigating the complexities of inflation control while supporting economic growth. The latest inflation data will undoubtedly be a disappointment to Chancellor Reeves, who was hoping for a more significant slowdown. As the UK's economic landscape continues to evolve, one thing is clear: the road ahead will be fraught with challenges, and the Bank of England's decisions will have far-reaching consequences. What do you think is the most pressing challenge facing the Bank of England in the current economic climate? Do you agree with Putin's stance on recession, or do you think there are circumstances where a recession might be unavoidable? How do you think the ECB's call to action will impact the global economy? And what role do you think China will play in addressing the trade gap?